For more on this theme of growth versus austerity, we're joined by Doug Dachille. He's the co-founder, chief executive of First Principles Capital Management, also former managing director at J.P. Morgan. And also we have with us Dan Wiener. He's the chairman of Advisor Investments, where he oversees about $2 billion worth of assets. Dan is also the editor of the Independent Advisor for Vanguard Investors and the annual FFSA Independent Guide to Vanguard Funds. We also have via telephone Domenico Lombardi of the Brookings Institution. He's a former executive board member of the IMF and the World Bank. Gentlemen, good to have you with us. Doug, let me begin by posing to you this idea of austerity and growth. Is it possible to have both at the same time?
Well, first of all, in the United States, the federal government is the last to the austerity party. I mean, you have to understand the first response to an economic downturn was experienced by the consumer and businesses. So they've already the businesses and the consumers have already recognized.
They've already gotten the message.
Right, they've already gotten the message that they had to deleverage, they had to pay off debt, they had to stabilize their balance sheet. So if you look at the end of the day, when you look at your aggregate economy, the first phase was to deal with that at the business level and the consumer level.
So that was a good thing,
right? And then after about 18 months or 2 years, the next entrance to the party was the state and local governments. We've been debating the issues of austerity, and many of them have already begun to address. Many at a state level, constitutionally, they have to balance their budget. And if you look at the activities of many of the state and local governments, they've cut their spending. And to some extent, you're beginning to see a little of that in the employment data, because you're seeing some element of layoffs at the municipal levels. So we've already seen austerity done by consumers, by businesses, by state and local governments. So really, this is just the natural phase of what we go through in austerity, which is now the big brother is now coming to the table to think about austerity.
Domenico Lombardi, come in on this topic. If we've been able to do this in the United States, and as Doug Dachille describes, this is almost a cycle that we go through, why isn't Europe paying more attention?
Well, the extent of the problems that Greece is facing right now is really unprecedented. And so far, there have been really little efforts from the side of other European countries in really supporting Greece in developing a medium-term program where there is not just austerity, which of course is needed, a substantial fiscal adjustment is needed, and the Greek authorities are working on that. But certainly, there is a need for growth prospects, for a light at the end of the tunnel. And this is what the current adjustment program is just missing, with the huge consequences at the social and political level.
Dan Wiener, come in on this idea of growth opportunities. Is there something better that's going on in the United States to promote growth opportunities versus what goes on in Europe?
The very first thing that nobody's mentioning here is that Greece has had 10 consecutive quarters of negative GDP growth. Or GDP loss, right?
Economy's contracting.
And the people do not pay taxes over there. I don't know about you, but I'm paying taxes every quarter. And we are, the U.S. economy has gone from recession to recovery to expansion. We are in an expansion. It is slowing down. But, you know,
But it's still positive.
Absolutely. And to go to Doug's point, people are saving money.
Doug Dachille, you were talking during the break that it is not so much the issue of worrying about raising money. It's what you do with the money once you raise it. Let's say if you have a debt offering, whether you're a company or in this case we're talking about countries.
Right.
Just give us the perspective that you're.
Right now, look at where the U.S. government. We're all worried about, you know, the fact that our debt is growing and we're not going to be able to roll over funding and we're going to have all these higher interest costs. The 2-year note is 38 basis points today. The 5-year note is 1.5%. So I mean, the problem.
Meaning it's cheap.
Right.
It's cheap to borrow money.
Let's put it this way: the government has a far lower cost of funding, for which it can then make investments than any consumer. I mean, if I try to take out a loan, it's prime plus 200. It's not 38 basis points. So at the end of the day, the federal government, despite the fact they have a large amount of debt, they still have the best borrowing rate of anybody, any individual, out there. The question becomes, when you think about the debt, is what are we doing with the proceeds? And where the problem goes is, because of the political incentives, a lot of those proceeds go to boost up short-term, immediate GDP through consumption. Give out the money, spend it. There's very short-term projects that immediately get consumed. GDP goes up. So in the short run, it looks great. But on a long-term basis, that spending wanes, and there's nothing that's going to go to prospectively create growth to pay off the debt and create leverage. When you just borrow and spend, that just doesn't create any leverage for the economy, any growth. There's no investment. Investment is what you need to do, and at these costs of funds, leveraged investment is a very good strategy.
Dan Wiener, come in on this, because
that's why you've seen large corporations go out and borrow 50-year, 100-year. They know that this is a great time to borrow money, great time to put that money aside. And of course, a well-run corporation knows how to invest for the future. And, you know, we talked before about the fact that there were some good investment opportunities. I mean, the flip side of what you're talking about is that bonds don't give you much of anything of a yield. Large stocks, those same companies that were borrowing a month or two ago and putting all that money on their balance sheets, they are tremendously undervalued relative to small stocks in the market right now. In fact, I was doing some numbers before I came over here. 25-year low on a relative PE basis between the biggest companies in the Russell Index and the smallest companies in the index. 25 years. These are great times for investors.
Domenico Lombardi, you were listening to Secretary of Commerce Gary Locke speak earlier about getting corporations to locate their operations in the United States. Is the U.S. better positioned to take business away from Europe?
Oh, yes, certainly so. First of all, Europe is not a nation. It is a group of, national economies. You have on the one hand of the spectrum, you have Greece with huge problems in terms of an enabling investment environment. And then at the other end of the spectrum, you have Germany, a very modern export-driven economy. But yet they are part of a monetary union, and therefore what happens in Greece does have consequences for the rest of the monetary union. And therefore what happens in Greece does have implications for the German banking system, for the French banking system. In the case of the United States, this is a much more homogeneous economic area, and especially policymakers in the U.S. have national-wide policy levers to leverage on. And this is really the big difference with Europe, which we are going through right now, where there is a problem in Greece, there is a problem in Portugal, there might be problems with other countries of the euro area, and yet the policy tools still remain at the national levels. And this is, of course, this is going to jeopardize the stability of the monetary union.
Doug Dachille, you're shaking your head. Come in on this.
When you come into the United States, you put your business in a state. And there's lots of states, and you have to negotiate with all the different states who's going to give you the best tax break. So it's not like we're one United States.
We've got regionalism issues here.
Right, we have the same issues in the United States, and the fact that they all aren't part. They're all part of the United States, but they're all separate. They have their own budgets, they have their own tax revenues, and they're all going to try. And having disparities actually is good for business, because I can play off one state versus the other state as to where I put my plant and where I build my manufacturing capabilities. So Europe should also have that luxury too. There should be a lot of competition among many of these countries to try to attract businesses by giving incentives.
Well, the Greeks
but the problem is that here in the United States there is a federal government. In Europe there is no federal government. Here there are authorities that have jurisdiction throughout the whole United States. In Europe, you don't have any of such authorities, apart from the ECB, which sets monetary policy at the euro area level.
But does this mean that it's better for corporations because at least they have the training to compete in the United States among different states? Maybe like the state of Alabama should be giving advice to Greece.
I believe that just about any of the states in our union could give advice to Greece. I mean, the government there is completely has done nothing for the country. They can't collect any revenue. That's why they're falling apart.
Gentlemen, I want to thank you very much.